So I had three experiences at funds prior to the one I joined, prior to founding my own firm. Two of those were pretty bad. The first one, within 3 months, I realized that the person I was working for was a pathological liar who was lying to all of us and very secretive about his business. The third fund I worked at, there were co-founders. They both were used to making a lot of money. The PM I worked for, I think he had a Hamptons house he rented. He had a driver. I think he had 3 kids in private school. That's a big expense base, right? I think those people were generally like nice, well-meaning people, but they just didn't love the work. And I think it's really hard to go somewhere with the founder that's going to be successful unless they really like love, live, and breathe the work.
This episode is brought to you by Fundamental Edge, the leaders in buy-side analyst training. You'll hear more about their new AI Academy later in the show. Let's get into it. Before we get started, I want to do a quick disclaimer that nothing we say here is investment advice. As well, nothing we say is advertising or marketing. For HF Reflections, any of their funds, strategies, or products, everything is meant to be informative about the fund management industry. Welcome to Other People's Money. I am joined today by @HF Reflections, one of the most prolific posters about the hedge fund industry on Twitter. HF, thank you so much for being here today.
Thank you for having me. And thank you for those of you that see video for humoring my interest in South Park. I appreciate it.
As I said, you are @HF Reflections. It is an anonymous interview that we're doing today. For anybody who is watching the video, they can probably see that you are a cartoon character. And for anybody who's listening, this isn't your real voice. So why don't we start with just anonymity and we can get all of the boilerplate disclaimers out of the way and get into the fun stuff.
Yeah, so really high level. I've been in the investment management business for 18 years. I really like the business. I love the job. I love investing, but I also find the business really interesting as well. I have had my ups and downs as everyone has. I've had some stints that didn't work out. I had one stint that worked out really well. And then after that, I decided to leave that really good stint and start my own firm, which is where I am currently. In terms of how I got on Twitter, I've just always been really interested in this business as a business. There's a really good forum to talk about the investment management business as a business. It's conversations I've had with people over time, one-on-one, but there was some kind of fledgling conversation around this online. I was really inspired by the way Brett, the Frontloading Edge guy, I think it was maybe 2 years ago at this point, just started to share a lot of really interesting, unique content about his experience working as a PM and what drove him to leave the industry. And I was just struck by how many talented people waste time on Twitter and really consume content that on balance isn't that good. And I think there were a few people, the two I think I thought most highly was Paul Enright and Brett. And then obviously people like Hindenburg, Kerrisdale at that time as well, just put out really good content. And I thought it'd be fun, especially in the confines of what I could communicate, because I can't talk really about investment ideas. It'd be interesting to share some philosophy of how I thought about the investment management business, get feedback on that. And it just kind of morphed into something that I ended up getting pretty passionate about. I think it was a way to get out some creative energy as I was looking at launching my own firm. And it was a little bit of a public sounding board of how I'm thinking through different challenges within the investment management industry. And so it's been exciting to be able to share some of my knowledge. I've learned a lot from other people in the community as well. And by doing it anonymously and by staying kind of higher level and talking more abstractly, I can do that while abiding by pretty strict compliance standards that exist as part of having an investment management business.
So you gave sort of a brief overview of your biography and what led you up to founding your own firm, but I think it would be helpful to go to a little bit more detail into how you got to where you are today.
So I'd say my path was part untraditional and part traditional, but the bulk of it was pretty untraditional and ended up becoming traditional somewhat accidentally. So very high level, I've been interested in business stuff for a long time. Like when I was a teenager, I did the most nerdy things you could possibly do as a teenager interested in business. There are all these business simulation games. I could literally rattle off like tennis. So I plays my favorite was there's one Wall Street Raider, which was made in DOS, which is like you're basically pretending to like be I think a Wall Street Raider, a corporate raider. You could do some cool stuff with stock trades. In that, there was this game called Capitalism 2, which again is just like super nerdy economic simulation. I don't know why I like that stuff, but I always have. My father was an entrepreneur, started his own business when he was 23. My grandmother and grandfather, entrepreneurs. And I got interested in investing probably when I was like an early teenager. I had no idea what I was doing and lost money very creatively, as people tend to do when they're young and don't know what they're doing. But it just always appealed to me. At the same time, I was interested in a lot of other things. I think one of the things I love about this industry is it allows you to be curious professionally. And so I've always been curious about different things. And so a big interest of mine has been more creative pursuits. So when I was growing up and as I went into college, I kind of split my interest down the middle. So as a writing minor, an economics major, I actually took more writing classes than economics classes. In the summers, I interned at a film production company. I interned at a literary agency. I was really interested in books and movies and thought I would potentially be interested in being part of that world. I spent a couple summers being a really bad assistant or an intern in both of those industries. I then also had some entrepreneurial interests that I pursued. In the summers, I just did it because I liked it. It helped my grandfather with a entrepreneurial business he had, and that ended up going reasonably well. I didn't do it because it looked good on my resume, but it probably helped me land my first job. So that's kind of the basics of my educational background. And then I think it came junior year, I realized I needed to start thinking about a job. My roommates across the hall were both in business school, and they mentioned something about consulting, which I'd never heard anything about. They couldn't tell me about investment banking because I might have done it, and that would have been a disaster. But so consulting sounded kind of interesting. I applied to a few consulting gigs early senior year. I got an offer at one. It sounded interesting. I was trying to figure out if I wanted to do something more investing and business related or if I wanted to do something more creative. I decided it'd be a lot easier to pursue something eventually in business if I started doing something more traditional in business versus trying to be an assistant in Hollywood and having that fail miserably and then trying to get a job. There's actually other examples I can share of people with random backgrounds. I have a good friend who was the first analyst at a successful fund who majored, I think, in marine biology and was like scuba dove for 2 years before he found a way into investment management business. So there are traditional and traditional ways. I kind of took a traditional way doing consulting. I did that for a year and a half. I didn't like it very much. I was interviewing at hedge funds and book publishing companies, and I decided to join a book publishing company. And so I did that for about a year. A basic thought process was I was, I think, 23. I wasn't sure what I wanted to do. I liked investing, but I also was interested in more creative pursuits. I figured I'd give it a year. Hopefully, I'd love book publishing. If I did, I'd do it indefinitely. And if I didn't, and I did investing on the side, I found I liked that more. I'd never have to wonder what if I didn't try something different. And so I think there was a period of about a year where I worked as an assistant at a book publishing company. I was really bad at that. On the nights, weekends, lunch breaks, I did investing work, which I really enjoyed and I found I was better at. And so about a year after doing that, I decided my career in publishing was done. I was going to try and be an investor. And I happened to decide that right at the same time that I think, forget if it was Lehman Brothers or Bear Stearns that had just gone bankrupt, but one of them had. And I went from one of the more favorable environments for looking for a hedge fund job to one of the least favorable environments. Thankfully, I was writing an investing blog on Blogspot, which is the modern day equivalent of Substack. And there happened to be someone that ran a small family office that read some of my posts. I was also a member of Value Investors Club, which I joined when I was at the consulting firm. And so through my writing, I ended up getting a job offer in, I think it was mid 2008 or early 2008, to join a family office that ran a concentrated small cap long only strategy. And so I gave up on publishing and joined that business in mid 2008.
There are two lines of questioning I want to get into. One is about the half-life of sowing your wild oats as a young person, because eventually it does get harder to make that transition. And people are willing to sort of grant you, okay, they're young, they're exploring, they don't know what they want to do. But that window to sort of go back to the traditional path can close rather quickly. How long do you think you have to test out the waters on other things before it gets really hard to come back to the industry?
That's a really good question. I didn't know the answer to that. My bias would be like, no one knows what they're doing for at least the first 2 to 4 years out of college. And you're young enough and moldable enough at that point that as long as you have a demonstrated interest, passion, and talent in investing, I think most places will always give you a chance, kind of 2 to 4 years out of school. Once you get beyond that, I think it's harder, but not impossible. I genuinely believe that the number of people in this industry that are super talented, that do really excellent work, it's not as many as you'd hope. And so if anyone like that exists and they publish content online, I tend to believe someone will find them and they will hire them, or they will be able to found a business, a Substack, a research firm, something along that lines, just on the back of their talent. But I think for like a traditional fund job, I think after 2 to 4 years of kind of messing around trying to figure out what to do, it becomes harder.
Now, this publishing side, that was the other bit. Did you quite know that it was going to be what got you into it, or you just did it because you enjoyed it?
Oh, I just wanted to write about investing because I liked it. I had no idea what I was doing. There was no intention there. I just was bored, and my publishing friends and writer friends weren't that interested in hearing about my investing pursuits. I didn't really have much of a network or community of people that I knew did it. And so it was just a way to share my passion for something. And I've always liked writing. And so writing about investing kind of came naturally. I didn't expect I'd get a job out of it, but I did. And it was great. And that's a throughput that would kind of follow. I think one thing that's benefited my career and I think is generally beneficial to people's careers over time is if you're really passionate about this business, you just love talking ideas and doing write ups. I just think it just helps. It just helps a lot in terms of getting yourself out there and good way to get exposure to different people. And so it's something I've always liked doing. I never did it in a very calculated manner. It's just come naturally to me. And I've met a lot of interesting people and had opportunities develop because of my passion for sharing my thoughts on investing topics.
That world has evolved quite a bit. I mean, VIC is still around. There's plenty of like the old stock blogs that I'm sure are still kicking, but Substack and the sort of paid research world has really popped off in the last few years. Do you think there is anything to be said about like staying free and sharing your ideas with everyone versus doing paid? So many people like are very defensive of their ideas. Like, what do you just think about that attitude that is pretty pervasive, that ideas need to be protected and kept secret?
One complicating factor depends what your roles and responsibilities are. So if you work in an investment management firm, there are compliance procedures that people have to follow, especially today. I think 10, 15 years ago, the rules were a bit less clear. Today, compliance has become much more front and center. And so, if you don't work at a fund, you can kind of do whatever you want because, I mean, other than not breaking the law, you have no responsibility other than to yourself. If you are an analyst at a firm, you need to be thoughtful about ideas you can share or not. Starting a Substack and building a business like that, I don't know much about it because I've never done it. I will speak more generically and say, I think in general, to the degree you're able to share research and stock ideas that you've worked on in a compliant manner, it's phenomenal for your career. I think most of the people I met over time and most of the way I got jobs that I liked was through interacting with people, talking about stock ideas. Now, I think when you work at a fund, you need to check with your compliance and what your investment management firm allows. But in general, my understanding is you're generally not allowed to talk about ideas you're actively trading. You can't do anything to disadvantage your fund. But if you built a full position in something, you're not actively trading it. And especially if you think there's a benefit to sharing the idea for your firm, whether that be getting feedback from other people you respect, maybe getting an activist involved potentially. I think there are a lot of mutually beneficial things about sharing ideas. And I think most people I know that have been successful in this business over time, a lot of them talk somewhat freely. So I definitely know people that hoard their ideas. I think in this business, there aren't many unique ideas. There's unique research, there's unique insights, but most ideas aren't unique. And a great way to develop a network, to develop a reputation for yourself and leverage the wisdom of crowds is to share what you come up with. And I think what happens tangentially if you do that is you can meet people over time that you connect with. It can help you find jobs. It can develop capital relationships over time. I don't think there's much of a drawback to it if done well and done in a compliant manner. So if I were like 23 and starting, I wanted to get in the industry, I actually wouldn't have a paywall. I would share my ideas somewhat freely. And I think it's actually probably the best way to find a job, especially for an untraditional background. Twitter, Substack, and just share your research. A person with a computer and a lot of resourcefulness and creativity and drive can do about as much as a highly paid hedge fund analyst and sometimes more. And if you put out good content and do good work, someone will find you and want to offer you a job or want to pay you to get your content more exclusively. So I'm very much a believer, especially in this world, that people have to be their own brand to some degree. And if you do good work and share that, you will have a career in this industry.
So your career really took off when you landed at the firm. that you worked for prior to the one you just started, but there were a number of firms that you worked at that didn't go quite as well. Can we talk about some of those earlier experiences in the industry?
So I had 3 experiences at funds prior to the one I joined prior to founding my own firm. 2 of those were pretty bad. One of them was fine. It was good. It just wasn't what I wanted. The first one was from the blog that I found. Within 3 months, I realized that the person I was working for was a pathological liar who was lying to all of us and very secretive about his business. I share this in part because you'd think it's kind of rare, but I literally just had a conversation with a friend of mine today that I used to work with who's encountering that right now at a startup fund that they're working at. So, like, there are some bad people in this business. I had the displeasure or pleasure, arguably, of having that as my first experience. And for those of you that have had that experience, I think the main takeaway, at least for me, was gosh, I need to go work with people that are good people that I like, that aren't going to screw me. And so the second job I had was at a family office that also had a long, short, concentrated investment philosophy. That was a really good experience. I learned a lot about just basics of investing. We had a fair amount of resources. I worked with good people that were smart and thoughtful. But one of the vectors that became kind of important as I was thinking about my career from there was the ambition of the family was relatively low. When you have a family office, several family offices are different, but a lot of them are more interested in keeping the capital they've worked really hard to have than they are necessarily trying to maximize that capital. And so you can just do a lot of things that are quite risk adverse. And while still can be an exciting and rewarding environment, it doesn't tend to come with some of the growth opportunity that exists in a more entrepreneurial role by people that really haven't made much money and kind of want to build a business. And so I worked there for 2.5, 3 years, good experience. I learned a lot there. It was kind of my formative investing training, which was good, but there just wasn't kind of the career growth I was looking for. I didn't have grandiose, huge ambitions. I just wanted to help to grow a business. And so the third fund I worked at had a lot of things going for it. And the founders had successfully run billions of dollars of capital at a prior investment firm. They had the right pedigree. They were young. They'd worked together. They had a big seed investor. It kind of checked a lot of the boxes. I also thought that a lot of the work and research that I learned to do would be additive to their process. They didn't do, in my opinion, as in-depth research as I'd learned to do. And I'm like, wow, they seem to be able to raise money and build a business. I can help with kind of the deep research that I've come to like to do and enjoy. They seem to value that. And I thought that kind of marriage would go well. I think I learned a couple of things there. One is I think you just need to be passionate about the job. I think those people were generally like nice, well-meaning people, but they just didn't love the work. And I think it's really hard to go somewhere with the founder that's going to be successful unless they really like love, live, and breathe the work. And I think that was not the case at that place. I also think that they had ambitions to manage and grow an investment firm, and they managed a lot of capital successfully. But just because you worked at a pod and managed $1.5 billion, the skill you need to do that versus build an investment business is totally different. I had assumed that as a marker of success that they'd managed all this money. And then I think as I got more on the weeds and now looking back on that experience and seeing how they did things, I just made a false assumption that they would raise money because that was successful. So long story short, I think all those experiences together were maybe 6 years. And so I'm 30, I'm working at a subscale fund that's not doing the best. There's a fair amount of turnover. And I have friends of mine that are doing really well. I think I'm pretty good at this job, but just haven't really had much success. And so that was pretty frustrating and I was pretty demoralized.
One question I want to get to before we move on to the next part is, what is subscale?
Really good question. I think it depends on your philosophy and your cost base. So I'd say in general, subscale is when the people in charge of the business can't pay their bills to fund their lifestyle. So there were co-founders. They both were used to making a lot of money. I think for them, subscale was probably like less than 150, $200 million in assets under management because they had very high lifestyle expectations. The PM I worked for, I think he had a Hamptons house he rented. He had a driver. Even though there were Ubers, I don't necessarily have a driver when they're Ubers, especially if they're not riding a very big fund, but he had a driver. I think he had 3 kids in private school. That's a big expense base, right? Flip side, the firm I joined after that managed a fraction of those assets, but it was a one-man band who owned his house and had good fees, and literally, I think was maybe a fifth of the assets of them. He was totally fine. He could hire someone, you could pay his bills off his management fee and his incentive fee. I think the answer today would be different. I think costs are different today, but again, it really just comes down to what's your expense base. If you can cover your costs and you're not, freaking out about raising money, I'd say you're fine. If you're freaking out about raising money and you're burning a hole in your pocket, I'd say that's upscale.
In the last year, the advancement in tools for AI investment research has been absolutely staggering, especially for professional equity investors. Despite this, uptake from the industry has been relatively slow because of questions about data quality, hallucinations, and how to properly augment existing workflows. These questions are valid, but the key question remains, can AI be used to speed up and improve the quality of investment research? Our partners at Fundamental Edge have spent countless hours working hand in hand with the technology providers and money managers on the leading edge of AI adoption, and they believe the answer to that question is a resounding yes. That's why this September, they're kicking off their first ever AI Academy for buy-side professionals. In this course, you'll get an 8-module curriculum led by their head trainer and supplemented by dozens of other experts, including managers already using AI and the industry's top technology providers. You'll learn about the evolution of these tools, what they can and what they can't do, insights for prompting, and so much more. Most importantly, you're going to learn how to deconstruct, analyze, and augment your existing investment process, not replace it, so you can do the research you're already doing better and faster than before. There are literally too many topics and experts on the curriculum for me to list here, so go to the link in the description and check out the syllabus for yourself. The course kicks off in just a few weeks and space is limited, so check out that link and reserve your spot today. Now back to the show. So the place you ended up going, with the benefit of hindsight now, today, it's very easy to look back and say, wow, what a great success story. But at that moment in time, that wasn't exactly clear. And you were getting looks from other places that maybe on their face looked like better bets. Why is it hard to tell what a firm is going to evolve into moving forward with the information you have, as a prospective new hire?
One, there isn't that much good content like this, like what you're trying to do about like what makes a good fund, what doesn't. And so that was one of the reasons I was interested in posting stuff on Twitter, was just trying to share, like, I wish someone had told me about the investment management business, that I knew a different paths I could take. And so I was 30 around the time I was exploring, looking at this other fund. I think a few different things that jumped off the page to me, and I'd suggest if anyone that's evaluating joining anywhere, whether it's kind of a big place or a small place. So one is just the talent of the PM and intellectual fit and just chemistry with that person. Ultimately, most funds fail or succeed based on the person or people at the top of the organization. I think that was the first firm I'd ever worked at where I was working for someone I really respected, that I thought was an excellent investor and I thought would help me become a better investor. To be fair, I never really had the opportunity to do that prior, nor maybe the experience or wisdom to know what that looked like. But by that age, I kind of knew what I thought good investing talent looked like. And I believe that person I was going that offered me a job was someone like that. Was one. I think two, the person had good integrity, genuinely loved the job. There are lots of very quirky people in this industry. There are lots of not nice people or good people in this industry. I think being like a sane, good, talented person in this industry is the biggest predictor of success. And there just aren't that many of them, honestly. And he was one. And I think it was very clear to me. So I don't think I'd ever really evaluate anyone on that basis. So I think that's kind of another thing was in his favor. I think the other thing was he had a very clear philosophy about what he was good at and what he wasn't. And he developed an investing philosophy. And look, a lot of investment firms and hedge funds are pretty generic. You can't really tell one from the other. Their presentations all look similar. You talk to them, they all kind of sound similar. This person had some different views on things. And it just came across in everything, every interaction you had with them. And I think people want something different, not just something that's the same as everything else. And I think the person I went to work for was different. And it was very clear to me, and I think to others, that they were different. And so you take all those things together, and I think you have some conditions for success. Now, could have gone a lot of different ways. I mean, it ended up finally going a way that was good. But I think on the flip side, looking for markers of success, like they came from a really pedigreed firm, might help you raise money. I think that's probably the single most overvalued thing that people look at. And I was guilty of this as well, assuming someone will be successful because they were successful in another firm. You have no idea. And there are a lot of people that join successful firms that don't have a lot to do with their success, but the right place, right time, and make a bunch of money. Or maybe in their earlier, younger career, they were really passionate and driven. And now they have a bunch of money, they don't care anymore, and it's a lifestyle business. It's just really hard to know. So I think people overvalue brand and pedigree when they're looking at jobs. I think people sometimes overvalue track record, especially short track records. Just because someone's done well for a year or two, especially in a very unusual environment, doesn't mean they're going to be successful in the future. The person that I decided to join had done well, not like, barn burner, like unbelievable eye popping numbers, but solid. And I think in a lot of ways, looking for people that don't have oftentimes the really high highs of amazing track records eventually come with very low lows. And I think also just looking for someone that's like slow, steady, doesn't take huge risks, isn't trying to be the best performing fund every year, but just trying to eke out good, solid returns over time. I think that type of business has a lot more longevity. I think also just a strategy that resonates. The person that I went to join had a very similar philosophy and research process that I had, did deep research on smaller companies, much like I wanted to do. Whereas the place I joined prior that didn't work out, they were more of a pod shop and invested on short-term data points, which I just didn't appreciate how different that was from the investing I like to do. And so I think right person is just there was a belief. For lack of a better word, I'd known this person for 3 years. I'd exchanged ideas with them at prior funds in a mutually beneficial way that never kind of harmed my employers and actually helped my employers because that person was very talented, had very good ideas, but was more resource constrained. And so I think it's one of the other benefits of talking to people. By the time I was working with that person, I believed it would work because we chatted for a while. I got to the person, well, I just thought would be a really good team. And so when I left to join that fund, it was more I was running towards something, not away from something. I did have the opportunity to go work at a larger fund that I liked and would have been fine and probably would have been the better decision because I was wanting to start a family soon and I felt like I had one more startup in me before I wasn't going to be employable much anymore because you can only be part of so many funds that haven't gone anywhere before the problem's you and not the places you worked. And thankfully, last thing I joined worked. But I found it always easier to like just go for the thing I'm passionate, excited about. And that was, I think, the first job I was really excited about in a way that made sense and I had confidence in. And things went well.
When you got there, what was already going well? What was maybe not going poorly, but just wasn't being worked on or looked at? And how did things really start to take off?
Sure. So I need to be careful. So the high level, again, I'm happy to share a lot of my experience. There are just very strict rules around what you can and can't share. It's frustrating too, because I think one of the things this industry's done to hamstring itself is because of some of the rules around what you can talk about as a registered investment advisor. It makes it difficult to share a lot from personal experience because it's hard to tell what can be construed as marketing, but what can be just construed as being helpful. So everything I'm trying to do, like, I have no real benefits doing this. I'm not trying to raise money. Like, no one has any idea who I am, like, on this call. I'm doing this more, frankly, just to try and protect. I just want to honestly just share experience with people because I do think there should be more resources out there. At the same time, I need to be careful. So I'll answer what I can to the best of my ability. So very high level, I think when you join a smaller investment firm, there was no real operations in place. The business had been in business for a few years. The assets under management were double digit million. There was the CIO, there was the assistant, and there was me. What we had going for ourselves, or what I think the PM had done a really good job of, is he had built a business, small, but built a business with a good LP base, had done a good job over time managing investors' capital, nothing barn burning, but no real disasters. He had a very defined process at that point. He had a very defined universe. I think he created a product that wasn't a Me Too product offering. If you were to look at kind of the types of investments he was making, you never would have heard of most of the companies he was investing in. And I think when you look at most 13Fs of investment firms, you see they all own the same thing. Or if you ever listen to podcasts on stock ideas or Twitter, just like a lot of people own exactly the same stuff. And there's a lot of think. He never worked at a big investment firm. He had basically no pedigree to speak of. He had some family money and was personable and charming and good looking. And so he was able to raise some money. But really, everything he did kind of came out of his own head, his own unique experience. And so I think the biggest thing he had going for him was he was a genuine, authentic person who was talented, driven, and had a different way of doing things than others did. That was our asset. He also had some connections. He'd been doing this for a while. And so he built up a mailing list of people that were qualified investors that he was telling about his experience over time, building relationships with. What we didn't have, or what he didn't have, was he had, and the marketing materials were like the funniest thing imaginable. I mean, Max, if you could see this, like it was actually, I think it was probably one of the more endearing things he had. I think a lot of people spend too much time on marketing. I think there was no debate how much time was spent on marketing. Like he didn't answer phone calls from people that were willing to invest. He was kind of doing his own thing, managing his money. He could, and some money for others, but there was no real infrastructure there. We had no COO. This was also back in the day when there was still a lot of the basics of the industry are being sorted out. There weren't a lot of expert networks that were existing. There weren't all the compliance procedures that are now common course today. It was a guy with a computer and some stocks and some clients, and that was really it.
So when you joined, you started to be able to help on the investment side. What about the other side of the business?
So again, I want to be a little bit careful, but basically the way I describe it is in the years before I joined, there just wasn't much of an effort to really get out there and meet potential investors. He was doing his own thing. He was also perfecting his craft a little bit. He started his business 4 years of professional experience. I think it took him a little while to figure out what kind of investor he was and to get the confidence to maybe go out and try and talk to more folks, see if he could attract other clients. So I think around the time he made the decision to hire me as the first investment professional, he also probably made his first concerted efforts to tell people about the business. And I think we hired a COO that year as well. And I think it was really the conversations we started to have with investors, happened more that first year. So just the high level, the business grew a lot. So I'll give the beginning and end. When I joined, as I mentioned, it was me, an assistant, and CIO. When I left, a multi-billion dollar firm with, I think, like 20 people, maybe 10 on the investment side. So that was the beginning, that was the end. The middle is a lot of stuff in between. But what I'll say kind of generically is I think there were a few things that we heated over time that were really effective. I think one, there's different levels of aggressiveness people take with marketing. Sometimes you see people go to every conference and they meet everyone and they're following up relentlessly saying, are you going to invest in my fund? This, that, whatever. I think you have people on the other end of the spectrum where like marketing's beneath them and they just want to be a PM and they really, really, really like hate the idea of talking to LPs or trying to attract investment. I think the person I worked for struck a nice middle ground where there was interest in growing the business, but not a desperation to. And I think when there's not a desperation to, and you get the sense the person you're talking to, they're happy what they're doing. They're happy to bring in partners if it makes sense, if the economics are right, if it's the right kind of person, but they're not going to bend over backwards to get a check. And I think he did a really good job. He didn't overexpose himself. We took meetings, we talked to people, we had materials, we did, some level of investor communication and outreach. We had like a basic list management system so we could see who was subscribing to our materials, who was reading them. That was kind of useful in terms of figuring out who spent time and attention with, but it was never the primary job. It was maybe 10 to 20% of time at max. And so I think what happened, this is kind of broader experience, I can say from having been in this for a while, having started my own firm now and having seen people I know build successful businesses, is we just got buzz at some point. And so what does buzz mean? How does that work? It's a little bit mystical, but I think it's true. And this is just reality. Like this is what tends to happen. I think it's generally what happened at my prior firm. You do well. You meet some people that are in the industry that said, hey, I met this interesting guy, some really quirky ideas. Maybe one or two of them worked. And, they meet and I meet the person manages enough money to be real, but not so much money that they're like discovered. And I think in the same way, managers like finding really off the beaten path stocks that no one's ever seen. I think allocators, especially good ones, like finding managers they've never seen. And so you start taking meetings and there's this kind of network and community of people that invest in smaller funds and they all know each other. They all tend to invest in similar firms. And if you get one of those people to give you a real look and invest, it just gives permission to everyone else that's in that universe to invest. And in the first couple years of working at that firm, we took a ton of meetings. Almost everyone said no. Family offices, high net worth folks, they can make a decision in a meeting or two whether or not they want to invest with you. They're great in that regard, and they don't really care how much money you manage. Institutions, it's at least, in my view, like a 6 month sales cycle, if not a multi year sales cycle. So we laid the groundwork, meeting a lot of people in 2013. But most of those people didn't invest. We never heard from again. And the ones that did invest, it could have been 2 years later, 4 years later. Other interesting things would happen is maybe someone liked us at a place and they didn't invest and they go move to another firm and now they have more discretion. And maybe we've done well since they passed on us or since they were forced to pass on us. They also just have churn where maybe one of your investors likes you, they leave, they get a new role, they have to rebuild the book. Maybe it's now a bigger fund. And so they have a mandate to deploy capital. And so just a lot of stuff like that happened over the year. But the real inflection point is we had a well regarded firm that was an institutional investor that got to the finish line with us. And they were respected, they were seal of approval. And once you get that, and I think it kind of varies, probably a little bit different today, but I'd say at that time, once you get to 100 or 150 in assets, I think it's a lot easier to get bigger checks. I think once you get to 300, it's even more easy. Once you get to 5 to 600, you graduate from a lot of the people like the ones that we're describing that like to invest in smaller firms, but then you graduate up to the people that don't have a choice but to write 50 or $100 million checks because of the size of their business. And so as you get into that range, then you start to be able to get bigger checks, and those people have to invest in you because that's the only way they're going to build. They have to invest in firms of your size. That's the only way they're going to deploy the capital they need to. And so then you start to have this weird dynamic happen where a lot of people that enabled your business, hopefully you keep them. But what sometimes people do is they take advantage of those people that built their business to then get the bigger checks. And of course, getting the bigger checks, the people that wrote those initial checks decide, okay, once XYZ endowment comes in and writes a $200 million check, we're out because we want to find the next person that we can write. It's a 50 or 75 million assets. And so I think what happened with us is nothing went terribly. Things went well. We had a lot of stability. We grew the business thoughtfully and slowly over time. And just you grew a little bit organically. You got another LP. That LP talked to other LPs. You start to just get a lot of inbounds from people that have heard of you, and you take those inbounds. And so for us, the business grew nicely, doubled in assets, grew 50 to 100% assets each year for the first 3 or 4 years. And then once we, I think, got to a size of around 500 million in assets, I think once you get to that size, kind of all bets are off. But if you're still kind of a hot thing at that point, if you still have done pretty well for your LPs, good reputation, you can kind of get to this point where there's almost a run on the bank. And so what I've seen happen, and this happened to the group at my prior firm, like, hey, we only want to raise X amount more money. And then someone's like, okay, I want in. And someone else says, I want in. And then suddenly the amount of demand exceeds the amount of capacity and things get kind of crazy. And some people take advantage of that to raise a lot more money than they said they would. And some people stick to their guns and raise less than they could have otherwise, which then says, wow, like, oh my gosh, you'll say no to XYZ big endowment. Most people don't do that. And, to be clear, I think as years went on, we did raise at that firm. The firm grew quite a bit. Some of it was organically, but a fair amount of it was kind of inflows from new investors. But I think the PM did a really good job over time, found a really good job over time of balancing growth of the business with managing the size of the fund so we could still do the kind of investing that we wanted to do. So yeah, it was a wonderful experience, and it was nice to have an experience and something go well after so many years of things not going well.
What about your own personal growth as an individual professional within the industry? What did you get to take on as the firm grew?
So I loved working at the firm I worked at prior to the one I founded. And one of the things I loved about that, it's one of the things I loved about doing entrepreneurial businesses. So like we had no idea what we were doing from a business standpoint. From the investing standpoint, I think we knew what we were doing. We're pretty good at that. But most people kind of accidentally have a business when they start an investment firm. You want to invest in stocks, but then once you get to a certain size, you need employees and you need systems and you need employees to do the things you don't want to do or the things you're not good at. And so these things tend to kind of sprawl. And I think what tends to happen, I think, to PM at a lot of these places is they go from basically being an analyst where they're doing kind of all their own research to then overseeing a couple people and still maybe doing some of their own research to suddenly getting to the point of, oh my gosh, I have 3 investment professionals and 3 operations people reporting to me, and I have to answer emails for 3 hours a day. And I'm not sure I can do much of my own work anymore. And what the hell do I do? And so one of the benefits of being an early employee at a place like that, especially with someone who's willing to delegate a bit, is it was able to raise my hand and say, hey, I'd be interested in doing this, or I'd be interested in doing. And so I think one of the benefits I had working at that last firm, it wasn't just the what I learned as an investor, it's what I learned about the investment management business. And there was a lot to learn. There was a lot to do. And I think my partner was very talented as a business manager, but also was very talented as an investor and knew he couldn't do it all. And so there were certain things I took on. So like one thing that I was really passionate about was I really liked working with younger people. Another reason I like I've been part of the community on Twitter is I like teaching younger people things. In my current investment management business, I hired generally younger people because that's just how what I've seen work well for me personally. And so once you get to a point where you're kind of hiring people, the PM's trying to figure out how to manage all their time, and maybe it so happens there's someone that's we hired and they're like, "Oh my gosh, I can't manage all these people. Can you help me out?" And so what happened in my case was there was a really talented analyst that we had that there was just too much going on with the PM. And so I took the responsibility to manage that person more and train them. And it was really awesome because I think when I was the first employee, the PM had more time. There wasn't a whole lot going on. The business was pretty simple. And so I'll never forget, like, we'd be on calls with management teams or calls with customers, competitors, etc. And we used AOL Instant Messenger. This is back in the day before there was Teams and Global Relay and all these things that we obviously use that now. But I'd ask questions of different people, and he would go on Instant Messenger and just light up my computer with all the things I was doing wrong, which I love because I never had anyone actually teach me how to do this stuff. And he was very talented at that. And it was great because I just got to shadow him and see everything he was doing and learn from him. And I was a sponge and I wanted to be a sponge. As the firm grew, I think he wasn't able to do that anymore because he was doing 10 other things. And I wanted to try what he did with me with some of the other people on the team. And I loved it. And I could do it. I was probably good at it. And so that kind of naturally evolved to I ended up working with trying to train the next generation of the firm. Those people also helped me on the investment research that I did. And I think over time, my partner and boss ended up doing a lot more with the more senior hires. And so as the investment firm grew, we hired some experienced people, we hired some less experienced people. Once the people got to a certain level of experience where they were basically too good to work with me, which I mean in a positive way, where would say like, you're too good to work with me, you should go work with the boss guy. And they go with the boss guy, and then they go out and find someone young and hungry again. And that process engendered itself kind of a few different times. So one of the great things about being a number two, especially the firm that starts to grow, is there are just so many things that need to be done and so many things you're doing for the first time. And so I learned more about the investment management business as part of that business and all the things to do well that I've tried to replicate in my more recent experience, kind of being along for the ride of that business and what happened over the 10 years I was there and then at that point in time. And it's a shame because I think unless you have an experience like that, where you are the number two somewhere that grows and becomes bigger, it's really hard to know what's right to do or what's not right to do. I mean, my prior 3 firms, I mostly saw what didn't work, not from an investing standpoint, really from a business standpoint. It wasn't really until my more recent experience where I saw how that worked. And I think also maybe to skip ahead a little bit, I think one of the reasons you see allocators sometimes interested in people that have had previous success in another fund, especially one that was smaller and grew over time, is it's hard. And it's not something that people normally learn. They tend to learn it the hard way when they go out and launch their own investment firm. A very talented investment analyst can launch a firm and have it go awry for a host of reasons. And so I think one of the best training you can have if you do want to start your own investment firm at some point is to hopefully join something smaller that becomes bigger. And if you do that, it's the best training possible for figuring out how to build a business of your own at some point, but also kind of what you want to do, what you want to replicate, and what you don't want to.
As you said, being number two is a great job. In many ways, it's like the best job because it's not all on your shoulders. So, what made you want to go out on your own and start this new thing?
So these are all personal decisions. So I really like investing a lot. I think one thing I didn't appreciate is I really like building the business. I also, as time went on, I had more of an opinion of kind of how I wanted to build a business and what I want that business to look like. And I think one of the great things about being number two somewhere is it's not your business. One of the worst things about being number two is it's not your business. And when something's not your business, it takes stress off in some ways, but especially as the firm grows, you're not making the decisions about things. You can, so at my place, I was very influential. One of the great things about working with my partner was he'd listen to good ideas. I think the sum of us, me plus him, was certainly better than me on my own. I've had to adapt to that as I started my own firm, but I was increasingly having other views of how I wanted to manage talent, how I want to compensate talent, of the kinds of investments I wanted to make and the kind of universe I wanted to play in. I also, frankly, was kind of curious, could I do this on my own? How much of the success we had was I just happened to luck into the best job ever? Or how much was I just like a bum that had worked at three failed funds and got lucky and able to go on my own and kind of fail miserably? These are all things that are personal. Like the economic decision, the best economic decision at that time was to never leave. And that's what most people do. They never leave, especially if things are going well. If things are going well, there's like no incentive to leave. To the degree people leave the lucrative roles at funds, it's usually when things don't go well. But look, much like my partner who thought about things differently, I thought about things differently. I was not trying to maximize my net worth. I was trying to maximize my enjoyment and fulfillment in my life. And for me, I increasingly reached the conclusion that while I would have loved to stay at the place I was at, and while it was very hard to leave, especially when things were going well and I was being treated well, I would regret not trying. And it was a very hard thing to think about and decision to make. I thought about it for about a year after I had that first inkling of thought. But ultimately, my excitement around building something new continued to grow and grow. And my excitement looking over the next 5 or 10 years of staying in my current role, while very lucrative, it just wasn't exciting in the way I want it to be anymore. And at that point, the decision becomes pretty clear. I could have, in theory, stayed and milked the opportunity I had, but that's not fair to my partners. That's not fair to the LPs. So I don't want to do that. And it just seemed things were going well with the business. Other people at the firm had begun to grow into more significant roles. So the people I'd been managing had grown as well. And there was this unique window where I felt like I could leave. The business would be fine. And it mattered to me because I genuinely cared and still do care about that firm and how it does and the people there. But I also had my own ambitions. And I felt like there was a unique window where I could leave to do what I wanted to do without harming them. And so that's what I did. And it was a really tough decision and thought process and conversation, but I got through it and did what I did.
So you talked about the personal decision to leave, but we didn't really get into the economic decision to leave. What about that side?
Sure. So I'm going to be a little bit careful not talk too much from personal experience, but I'll describe the high level things I think will be relevant to the audience. So in general, if you've worked at a place a long time, you tend to have something called phantom equity. Phantom equity generally refers to points in the business. Sometimes it reflects itself as a percent of the management fee. Sometimes it reflects itself as a percent of the incentive fee. There can be other structures as well that exist. But in general, if you've been at a place a long time, you've done well, and you have a good boss, you'll get something of that. So one of the toughest things about leaving, every place is different. There's certain places that have what's called a sunset provision, where if you leave, you'll continue to get some tail of economics for 1, 2, 3, 4 years. Well, it's more often the case if you don't have a tail provision. So I'm making this up. Let's say you have 20% of the business. You're entitled to 20% economics of that business. If you make the decision to leave, you walk away from that whole thing. Now, and especially if you're talking about a multi-million-dollar business, and by the way, that's not the percentage I had. I'm just talking generically because that's an easy round number. That's a lot of money. So most people don't leave because the amount of money you're giving up relative to the amount of money, I was just have some fun with numbers. So again, generic. So let's say you have a $2 billion fund and there's the number two that has 20% of the economics of the business. You need to make some assumptions, but I think you can assume, let's say there's 1.5% set management fee. There's no seed. That's $30 million of revenue to the management company. I can almost assure you there's no way in hell that $30 million of revenue is being shared to all the employees. That management company is going to be very profitable. I would suspect, I wouldn't be surprised if it has, even after paying bonuses in a pretty good year, something like $5-10 million of profits. So if you have 20% left over there, that's $1 million to $2 million to someone who has 20% of a $2 billion fund. And you have the incentive fees. Let's say it does 15 gross. So that's roughly, what we're talking about, $300 million of P&L. You then need to deduct probably another 30 million again for management fee because that comes off the top. Maybe have some fund expenses. So maybe you're now down to 250 million. Let's say you have 20% of that's $50 million. 50 million times 20% is $10 million. So hypothetically, you're talking about teen millions of payout for frankly, what isn't an amazing year. That's a big thing to walk away from. As long as you're there, get that in perpetuity, unless the person decides to let go of you, which in practice is kind of hard to do because if you've been somewhere for a long time and you've done pretty well, one of the biggest reasons allocators will pull is because someone that's been successful plays for a long time leaves. And so it's a really, really good job. So the economics, it makes no sense to leave that. I mean, unless you get like a huge payout from a pod, which, at least personally speaking, most people I know work at single managers, no one would ever do that because working pod sucks. And like you wouldn't actually be able to do the investing you know how to do going for a single manager pot. But that's not here or there. So that's one side of things. But the other side of things then is so a couple different things I think they're offsets to that. One is how much you care about money. So how much money do you have? How much money do you spend? So in my case, I had enough money that I felt like I could underwrite very conservative return assumptions, call it like 5% a year, and I could basically live my lifestyle infinitely. And so if that's the decision making, and the downside is, wow, I left this amazing job where it's going to make a lot of money for longer. But how do you trade off that and your net worth going up versus, the once in a lifetime experience to do something you've always wanted to do since you're a kid? And for me, it's really simple. It's like, well, if I can support myself and this is a total blazing failure, what will I regret more? Will I regret more having half or a third of the money I'd had if I'd stayed in the other thing I was doing for another 5 or 10 years? Or to regret it being a total failure, but know that I did the thing I always wanted to do. And much in the same way I decided when I was younger to pursue book publishing, even though it was economically incredibly stupid, I once again decided to do something incredibly stupid economically to do what I actually want to do. And so I don't think there's any argument to be made economically unless the economics aren't that good, the fund you're at isn't doing that well, or the firm you're at is doing that well, to leave. So it was not an economic decision at all. But because I'd done well and because my cost base and how much money I saved up, I was able to do it in a way that it wasn't catastrophic. So one of the benefits of starting a firm when you're older is you can do calculus like that. You have more capital connections. All your friends that you knew were 30 that had, X amount of money, they now have X times 10. Some of them might have X times 100. So it's a lot easier to get your business off the ground. The downside is you have higher expense base. You have a little bit less energy, though I think I probably still have. I frankly starting the fund has made me younger again. The starting the firm has made me younger, especially work with younger people. But one of the big benefits of waiting over time is you just have a better base to go off of. But hopefully that's helpful. And the other thing I'd maybe just say at a high level now, having been through this, is the number of people that are really good that leave firms that are doing well, where they've done well, is almost zero. And so if that describes you and you've not been living in a cave and you've met people over time, people in the industry know who you are, and you go launch something, it doesn't mean you'll be successful launching it, but you will almost certainly get looks. And the number of launches that have that background are very rare. Most people that launch funds do it because they're unemployed and they have no other career prospects. They do it because they hate working for the idiot they're working for. They think they can do it better. And most of those cases, they can't do it better and they don't have much money and they don't have much pedigree. Though occasionally they can do it better and they have crazy successful careers. Some people just have always wanted to do it and they just do it, not necessarily out of a place of resentment, but just out of like, I want to do this and I can go multiple ways. In my case, and just stepping back for a moment, I think especially older in life and having done well at the place, it's not an economic decision. It was a passion decision that was supported by having a stable base I could go off of.
What about the proverbial two men in a garage with the Bloomberg terminal? Like, how does the calculus change if you are late 20s, no cost base, and you're trying to do it that way? Because I think actually you were one of the people who pointed this out to me, that if you look at like a lot of the great single managers of all time, like a lot of them actually founded their firms when they were 27, 26.
I mean, the failure rate's high, But again, like, so the person I worked with, that was their story. They started their business, I think, in almost, I think, 18 years ago, no, with 5 million assets and now a multi-million dollar business. And as much as you hear, XYZ left Viking and launched with $1 billion, or whatever the hot fund is this day, you still have, Joe and Jim in the basement. That those still happen. They still happen. They're not as common, but they still definitely do happen. And I mean, I know around the time that we launched our firm, there were a couple other people that I know that good backgrounds, didn't raise the capital they were hoping to. But I think in two of those cases in particular, they've absolutely crushed it. And I think they built their business now to a size where they can get real institutional checks. And so I can just talk in generics. I think one launched with about 40 million assets, two people with good backgrounds. 40 million is not bad. It's not bad, but it's not quite like institutional scale. They put up a couple great years, and I believe they are in the process now of inking like $100 million SMA. And so they're going to go from, 60 or whatever it is to 160. They're in business. It took them 2 years of a little bit of stress, and now they're off to the races, and no different than, there's no reason they can't be as successful as someone that launched with 150 million assets. No, it's a little bit more complicated if you launch with 10, right? The problem is the size you are determines the checks you can get, right? So in the example I gave where someone launched with 40, and I'm going to give another example where someone launched with 10. I know someone launched with 10 that's absolutely crushed it. I mean, even better than the other one. I think they're maybe now up to like high 20s or mid 30s in assets. Great track record now. They will probably go out and raise more money, but they're now at 30. And so there's just, I
The
mean,
people,
you can maybe get an SMA with like, 0, 10 or 50 bips and 10 from a big Ivy endowment. You could probably get that now, would be my guess. The problem with that, though, is if you take that, then that sets the benchmark for kind of all your other investors. You can try and raise beyond that, but there are some consequences of that. They're going to be fine now. Point being is they're going to be fine. So I genuinely believe if you're really talented, you put up good results, you will have a business. Your cost base needs to be low. You need to gut it out and work through those years where you're just kind of building your business. There's also a high failure rate, which is just what it is. Most people like aren't that talented. Some people get unlucky. If you're taking 20% positions and you're right 60% of the time, but your first year you happen to be right 20% of the time, because that's going to happen over the course of being right 60% of the time, especially if you're concentrated. Like shit happens, and you could be out of a job. So your fund could not get off the ground before it happens. So you just kind of got to decide whether or not it's within your risk tolerance or not. And so that's not a decision I made. I'm sure there are a lot of people you can get to talk about that experience. Some of whom have made it, probably more of whom who haven't, but it happens. People can do it. But look, I do not recommend someone go start an investment firm unless they have the expense base and stomach to brunt it, and unless they think they're really talented and can put up like numbers that can justify the fees. Most people can't.
yeah. So you did the math. The math worked for you. What about the plan?
Sure. So again, I'm going to talk kind of very high level. I'm going to talk maybe more generically if I can about if I were starting a fund today, or someone was looking to start a fund today, kind of ways I think people can go about it that could be helpful. So I think first thing I'd say is, so what's your timeline, right? So let's say you're leaving your place, you got to launch your fund in however long. So a few different things I think keep in mind. One is the best thing about being a new launch is you're a rookie. But what I mean, you're a rookie is you're all potential. People, in my experience, like investing in rookies, in rising stars, and sometimes in all stars that are established people. When you're a rookie, you kind of all look the same. You have unlimited promise and potential. There are some rookies that are more talented than others, but you'll get a look. And there are people that like being day one investors for a whole host of reasons. So, a few different things. One is you have a timeline where you can maximize being a rookie. So, my general view is that it takes 6 months to a year between when you have a first meeting with someone to when they'll write you a check. So one thing I've seen people do is they're like, oh, I'm going to hire Prime, get service providers, like almost a fund in 3 months because they want to get things off the ground right away. I personally think it's the best idea. I think taking you 6 months to a year, closer to 9 months to a year to actually launch is better because it will give you more of a chance to get your story out there to people that could, in theory, write the day one check to you. So the way I would think about it is I have a year. What needs to happen in that year? Let's just use a year as an example. Well, I need to get my basic business off the ground. I need to share my service providers. I need to figure out what my strategy is. I need to put together legal docs, decks, etc. Certain things have long lead time. Certain things have short lead time. In my opinion, the first things to do are to figure out what's your strategy, what's your selling points, put together some basic materials. Two is to get your story out to every single person you possibly can that knows you and has money. And so one way people can do that is something called a launch letter. When you're not SEC registered. So by the way, I'm not a lawyer. This is not legal advice. This is like my general personal experience. For what it's worth, don't rely on anything I'm saying. But the way I think about it is, so I have a year to convince a bunch of people with money that I'm worthy of getting that money. So how do I do that? Well, I need to create a product that's interesting. And so all else being equal, if I have a product that looks like everything else in the market that has low fees attached to it, I think it's really hard to raise money, unless you're a former OpenAI researcher that can launch a $1.5 billion fund, when you're 24, like power to you. But for most of us, like there's the competition's QQQ. It has almost no fees as daily liquidity. And it's really hard to start a TMT long only fund. On the other end of the spectrum, if you're launching a global small cap fund or a small cap Korea activist fund, I know someone that has a small cap Korea and Japanese activist fund. Like, good luck finding that product at 50 bips. I don't know who wants that product, but someone does, right? And so we have a product that is going to appeal to someone. It doesn't need to appeal to everyone, right? Your job isn't to get everyone to want to give you money. Your job is to convince a small number of people to take a chance on you. And that means you want polarization. You want to get some amount of people to like you a lot. So that's kind of the goal. That's what we're driving towards, right? So because those relationships take a long time to develop, because it takes people want to know who they're giving money to, you need to, in my opinion, figure out how you're going to reach those people and reach those people in a timeline that works for your business, not a timeline that works for them. So I think front loading the marketing efforts, getting yourself out there, figuring out how you're going to approach people, starting to have those conversations and introductions. The earlier you can do that, the better, because it starts the clock. I think the second thing that's helpful too is figuring out, so in my opinion, you focus on the people that write day one money, not the people that invest after year three. The way it's going to work is, if you do well, at least I think, especially if you're more pedigreed of a manager, like if you do well, people are going to write you checks at some point. Like they will. If you do well, people are going to write you checks. The hardest thing to do is get someone to write you a check when they don't know if you're going to do well or not. So you can practice if people aren't going to write you a check for 3 years, but all else being equal, like you want to spend as much of your time as possible with people that occasionally invest with emerging managers, whether that's kind of day one or maybe first 6 months or first year. So I think having a process where you just screen people in the same way they're interviewing you, a lot of times they'll offer, at least in my experience, they offer, say, hey, can we tell you anything about us? And you'd ask questions of, hey, do you invest in day one managers? What's your typical check size? What's the last manager you invested with day one? Because someone could say we invested day one managers, but they said, oh, we haven't done a day one check for 5 years. Like, probably don't actually invest in day one managers, right? Are you making allocations now? Because a lot of people aren't making allocations right now. They're just meeting with new managers because they have to do something with their time. So I think not just going through the funnel of trying to convince people to invest in your fund or saying why you should invest in their fund, but also qualifying them as a potential investor and should I spend time on them or not, I think is really useful. Talking to people that don't fit your mandate doesn't make sense. In our experience, I had a vision of how big of a business I wanted to have. And that view of how big a business I wanted to have conflicted with certain people that need to write really, really big checks. And so it feels really nice to talk to the guy being endowments that can write you big checks, but it made no sense if you want to have a smaller fund to talk to someone that needs to write you a $400 million check. And so to do it, probably doesn't, frankly, having some of those people interested is probably helpful. But I think relatively quickly, if you're time constrained, just like, no, this doesn't make sense. And I think if you know who you are and you kind of tell people, hey, I'm not targeting people for $400 million checks. I don't want to have a $400 million fund. Like it sends a message that you have some confidence, you know what you're doing. That's trying to raise money and definitely trying to build what you want to build. So I think just having a really thoughtful strategy of how you plan to approach people, I think is helpful. So that's kind of one thing I think that's important. Two, I mentioned is having a strategy that's genuinely you. I think the third one is just being authentic with whoever you happen to be and whatever you happen to want to do. I would not try and be who you think allocators won't. I would not try and say what you think allocators want to hear. if you try and be someone else and you are fortunate enough to raise money from them, you're going to have to be that someone else forever. If you are naturally yourself, you have the privilege of being yourself for the rest of your career with investors that invest with you because you are yourself. I can't help you if you're not someone people want to trust their money to, but better if you probably find that out sooner rather than later. I just don't think it's feasible over time to be someone else's vision of what you want versus being your own vision of what you want. And I think the number of people that start funds that have a clear sense of who they are and what they're trying to do versus the number of people like, yeah, I want to have a $500 million fund and great to be a couple billion over time. We're going to invest in companies that trade more than $20 million a day. And we own, XYZ hedge fund hotels. Why? Like, who's going to write you a check as a rookie? But obviously, it's not all marketing. So the way I think about it generically is you need to do marketing, but ultimately, if you don't have good investments that perform well, you're not going to have a business. And so I think front loading marketing is helpful depending where you are. So, if you have a fully fledged portfolio, maybe the calculus is different. So if you left a prior fund and you want to launch with all these ideas you're crazy about, maybe that makes sense. In my case, I was going to back to much smaller companies and I had nothing kind of ready to go. And so I think my thought process was if you front load marketing the last 3, 6 months, like you just need to focus on the portfolio because if you don't have a good portfolio that does well, you're not going to have a business. And so for me, what I did is I thought about what do I need to accomplish over the next 9 months. One is hopefully attract some people interested in what we're doing. And the second is we need to put together a portfolio that we think will perform well. And so I think being thoughtful about, hey, this is what I'm doing. I'm willing to allocate this much time to talking to folks. But then if we're 3, 4 months ahead of launch and I'm meeting someone for the first time, the odds someone's going to meet you 3 months ahead of launch, all right, you check day one is almost zero. So why the hell are you talking to someone you've never met 2 months before launch? You don't. Likewise, if you're taking a second meeting 2 months before launch or 1 month before launch, the odds that person's getting over the finish line, unless they're high net worth before you launch, again, it's almost zero. So I think in general, depending on the place, high net worth can literally make a decision after 1 or 2 meetings. Family office, depending on how institutional it is, 3 to 4 institutions, like big institutions, endowments. I mean, like literally 5 to 10, and they might still not even write you a check. So I think knowing that in mind, you kind of have a sense of, okay, how far along am I until launch? Like if someone, an endowment, for example, you have 5 months to launch and they want their second meeting 3 months before launch, instead of saying, okay, that's fine, I say something to the effect of, look, like by that time, I'm going to be spending all my time on the portfolio. If you realistically are interested in potentially investing in one, I'd suggest we meet, in 2 or 3 weeks, because otherwise it's just not going to work from a timeline standpoint. Now, if they say, come back and say, look, we don't have time, all right, you run the risk, you move on, call it a day. But realistically, you let the process extend to their timeline, not yours. It's not going to work. So I think there's that aspect of things that's really helpful. But then ultimately, I think right before launch, at least my opinion was I want to spend all my time on investing, building the team, working with the team. And what's nice then at that point is hopefully if you've front loaded the marketing, you can get some buzz building. So the way I think about this is all allocators talk fund managers, like fund managers talk stocks. And if you talk to the right people and you make the right impressions, some people say, hey, have you met with this XYZ person? Oh, yeah. I thought they're interesting. And maybe they haven't. They lied. And now they'll go out and contact XYZ person and then they'll intro them. Right. And then there's cap intro, which I'll talk about in a moment too. So cap intro, if you are going to launch with like almost no personal capital, you didn't come from a pedigree firm, cap intro is not going to help very much. If you worked at a fund that was a known entity and did pretty well, and you left when the fund was still doing well, cap intro can be really helpful, especially if you have a relationship with primes while you were there and you were good clients. They can really be quite helpful. A lot of people kind of put cap intro. I think my prior firm put cap intro. I think cap intro can be very helpful. I think it'd be very helpful for a few different reasons. If you can get access to them, which again is somewhat hard. One is they know everyone. A lot of allocators will talk to cap intro teams and say, hey, who's launching? Who do you think's interesting? Right. And so I think one of the things that I learned from another manager I thought was really thoughtful is he went and interviewed primes. One of the first things he did was marketing stuff, but then also interviewed primes. When you're talking to primes at the beginning, primes are desperate for fund launches, like they know that all funds they're working with, they're going to lose 20, 25% every year. They don't know which funds are going to be successful. And so they'll spray and pray. I think most of the big primes will launch 40, 50 funds each year, knowing 40 of them will fail and 10 of them will do decently and 2 or 3 will become multi-billion dollar funds that going to help their business 3 or 5 years out. And so if you present well and have some good pedigree, they'll offer you some stuff. So again, I didn't know this. I'm saying this more as a public service. So like capture teams have operation consultants. The operation consultants, all they do is help fit funds, choose service providers, and start businesses. So if you go really early with them, like they'll give you a bunch of diligence materials on all the different lawyers,
Lawyers and
fund
admin.
admins, all that different stuff, right? The other thing they'll do sometimes is you can say, hey, can I talk to you? I'm trying to figure out which prime or primes to choose. I'd love to meet your capture team. Sometimes they'll give you the finger if they don't like you, but if they like you, they might give an intro with the capture team. Capture person is a totally different incentive structure, in my opinion, than the prime group. The prime group wants clients. The capture team wants the prime group to like them, but they also to be useful, right? If they're just trying to sell their own primes clients, they're not going to be very credible. And so I think they also traffic in information. They want to know the hot launches, the good launches, and you can ingrain yourself, I know of a situation where there was a new launch that chose 2 primes. There was a third prime the launch did not choose, yet that prime got more introductions from the prime it didn't choose because they developed a really good relationship with the capture person who who believed that fund was going to be a successful launch and thought that their credibility would be helped by continuing to talk about that fund and get information on how that fund was doing. So again, you can't make this stuff up. And I didn't know this existed kind of at the time, but Cap Intro, their job is to talk to allocators about launches. If Cap Intro likes you and thinks you're good, they'll be a mouthpiece for you. If other allocators you meet with hear a good thing about you from a Cap Intro team and they meet with you and they like you and their buddy met with you too, this is kind of how buzz gets created. And the magic happens to the degree you can get someone over the finish line, create capacity constraints. So I'll talk about that. So when I was thinking about building a firm, I treated the process of building an investment firm the same way I would as researching a stock. And so what that meant was I talked to a lot of people that started funds, talked to people that failed. I talked to people that were super successful. I talked to people that are moderately successful. And I tried to learn from their mistakes, from their successes. And the people I talked to that did really well. And by the way, anyone looking to launch a fund, meet with everyone you know, tell them at some point you're looking to start a business and ask for their advice and ask if there's anyone you should talk to, they should talk to. You do that 10 times and you're reasonably well connected, you'll get 40 or 50 meetings and you'll probably get introductions to GPs. Because the other thing will happen is when you tell people, almost everyone that started their own fund definitionally is an entrepreneur, right? If they're an entrepreneur that likes you, they will potentially introduce you to other people, but they'll also introduce you to GPs. And so if you have someone, the other thing I'd say, let's say there's a fund manager you've made money for on something. And this people usually happen. Let's say you pitch them a stock idea at an event or you call them up about something and it was like a home run for them. Certain people won't care and they won't return your call. But there are people that are just connectors who will be like, oh my gosh, yeah, I'll introduce you to like these 3 or 4 LPs that I think would love you, right? And you just cannot, the quality of that lead, if a GP recommends you to an investor of theirs versus anything else you're going to get, it's like the close rate on something like that's probably like 30 to 50%. The close rate on a cold inbound is always going to be certainly for the first year or two, maybe like 3 years later, it goes lower. So trying to get as many of those high quality leads you can as possible and asking for advice is a great way to get things. You also need to be helpful to these people as well. So I wouldn't reach out to people that you never did anything with. But I think one thing I didn't appreciate, but I think has been really helpful. If you're a reasonably good human being that tries to help people over time, you will find out how many friends you have when you start trying to start a business. And I think in my case, I was pleasantly surprised with how many friends I had, but they were different friends than I thought I'd have, which is also interesting as well, which is why I think you tell everyone in your life that you're starting a business because you won't know who those friends are until after you've sent out an email like that saying, hey, I'm launching a business. So anyhow, long story short, I think most of the funds I know that launched well, I'm not talking about people that like worked at Viking or Millennium or whatever and had, like left the capacity constraint fund that did really well and launched $1 billion. I don't know anyone like that. I don't know I'm talking about people that launch between like 100 million and 500 million, which in today's dollars is probably equivalent to like 75 to 300 because it's harder to launch a fund today. It was 4 or 5 years ago. What they did is they were well liked, they were well regarded. They had some people that they knew from fund they worked at prior. The fund they left, usually the PM or multiple people invested in the fund that they started. People generally only had good things to say about them, with some exceptions, but in general, like their reputation was largely positive. And then to varying degrees, what happened was there was a lot of people hanging around the hoop, but no one invested. And then some point, 2 months before launch, 2 weeks before launch in one case, someone said, "Hey, I'll write you a $30 million check." And you went from having like $15 million of friends and family money to having 45 million, $50 million. And then if you said you want to launch with no more than 150, and let's say the people hanging around the hoop that collectively would write $400 million checks. Once one person goes, and especially if that person that goes is well regarded, it gives the second person permission to write a check and say they're in. And then that kind of goes and goes. And then you hopefully get to this point where you now have, I'm making this up. Like, let's say you have a founders class, and let's say you don't want to raise more than 150 hypothetically. So if you get to a point where you've had one person, let's say you have friends and family and personal like 20, and then you get, one person to say I'm in for 30, and you get one person to say I'm in for 10, suddenly you have 60. And now you can go with people and say, "Hey, I have 60, capacity is 150. We're still talking to some folks. Um, you know, where are you at? Like, no pressure. Like, I'm just trying to figure out, I have a business to build, trying to figure out how to spend my time and to get to investing. I just want to let you know, I think we're starting to run out of room. Like, I have no idea how much money we'll raise. So far, it's gone pretty well. But again, I don't know. No pressure. Just let me know what you're thinking." And when you do that, you'll probably have some people that say, "Oh, look, like, we're not writing checks right now," or "We like you. We're just kind of monitoring," which is great. It's a no. Sometimes they'll say that's really return to call. I don't return to call, chances are they're not interested. And so then you just know where to focus. And so hypothetically, if there are 15 people hanging around the hoop, maybe 5 of those say, "We're interested, we're working towards day one, but honestly, I'm not sure we'll get there, or we're probably not going to get there." You might have 5 that say, "Look, we're definitely interested." And maybe they'll push forward their process a little bit and like get a little bit more on it. And you maybe have 5, they're like, "Oh yeah, we're definitely interested. Like, we should keep talking," and they'll like kind of get on it. And so it just becomes easier. So let's say you get a couple more checks. Suddenly you're at 100, you have 150 million capacity. Now you're getting really tight. And then what can start to happen is you just call people up and say, "Hey, like, just so you know, founders class is almost gone. I'm running out of room. I want to get to invest in the portfolio. We're going to stop marketing in a month." I think this could obviously not happen, in which case you can't lie, but you should tell people where you're at. And the goal is just get a couple people over the finish line. You get 4 people over the finish line, it's a lot easier to get another 10 people over the finish line. If you can't get that one person over the finish line, and a lot of people don't, and sometimes it's luck, sometimes the market. Like, I know someone that launched in April 2025. Like, look, if you're launching April or like May 2025, if you launch in May 2025 after the tariff tantrum stuff, like, it's gonna be hard. If you try and launch during COVID, like, like, you just can't make it up, right? So there's a luck element to all of this. I think anyone that also launched well, like, had some element of luck to them. But you just put yourself in the best position possible for luck to equal success. And so hopefully it's helpful. I think those are some high level observations. And if you're able to achieve that, then you can launch with like a real amount of money. And then if you launch with a real amount of money, you can hire people. And it becomes, as I mentioned earlier, if you're launching with 40, it can work. If you're launching with 10, that can work. It requires a different level of patience. If you launch with 150, that can work as well. Ultimately, the success 5 years out is going to have a lot less to do with how much money you raised and a lot more to do with how well you did and how you treated your LPs. And I also would encourage anyone, just because someone that launched with XYZ amount of capital, like, the value in this business. Well, first of all, like, there's just a joy to this. I think personally, I'd rather be associated with something that performed really well than manage the maximum amount of money possible. Cause I'd feel like a tool if I, raise a bunch of money and milked fees for no value. But the other thing I genuinely believe is the value. I think that my prior boss said something, the value of this business is being in business. And so if you can stay in this business for 10, 15, 20 years and compound capital at a high rate, you will definitionally be successful. If you raise a bunch of money at the start and you're out of business in 3 years, that's not worth very much. And your career's kind of over and you're going to feel miserable. So it's not fun being a part of a fund that doesn't do well. It's very fun being part of a firm that does well. And raising money is a part of that. But the bigger part of that is just having culture, performance, strategy that resonates with you and other people. And so You do the marketing. Once you're no longer a rookie, now you're kind of a commodity out there. And if you put up really good numbers one year, you can get someone's attention. If you put up really bad numbers to start, it's really hard to overcome that. Most people I know that launched, regardless of their size, what tends to happen is one of a few things. One is they put up some amazing numbers first year or two and they get thrown money, which can be good or bad. Sometimes that money's faster, and so it's not necessarily the best thing. Sometimes they go out the gate and it's like mediocre to not good. And I think it's just really hard if mediocre to not good to recover from that. And then I think the most common one that I've seen is people do solid. They do solid, 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 and then they have a really good year. And you do that for 3 years and you give people like no reason to not invest. I think people overestimate the value of being the best performing fund that they know. I think it's much better to have a strategy that happens to generate like pretty consistent returns over time with occasionally some really good years and nothing like horrifically bad. I think you have a much less stressful life. I think you have a much better relationship with LPs. I think you have a much better business than if you CAGR at, 10% higher, but with drawdowns of 50% regularly. Now, a lot of allocators will tell you that they want the highest return possible and they like the drawdowns. In practice, I question the degree to which that's actually true. You need to do what's authentic to you and what's genuine to you. But I think another thing actually that, and this is just go back to my prior fund, I think something I've seen people do well. So again, you have to think about it from like an allocator's perspective, right? So like one thing I find interesting is people assume so much of allocators that they're sharing their baby with them and their business with them. And they should of course give them money because they generate returns in excess of the benchmark. Like allocators owe you nothing. It's their money. They're entrusted with that money. If they decide to give it to you, that's great. If they don't, there's a whole list of reasons why they don't give it to you. They might not have capital they can give right now. They might not like you. They might like you, but not need your strategy. They might like you, but not your COO. There's just all kinds of reasons why people say no or just say nothing at all. But one thing I think I've seen some people do really well is if you have a strategy that's maybe not super concentrated, or you're not taking a lot of factor risk, you're kind of thoughtful about the risks you're taking, is do a pretty good job like doing well, never having crazy, crazy up years. Because to have crazy up years, you generally need to take a lot of risk and a lot of concentration. We also have never crazy down years. There is a big market for people that beat the market over time, not with the lack of vol of like a multi-manager, but not with the vol of someone that runs like a 6 stock concentrated portfolio. Most allocators, they have a lot of different investments they're making. So if you're talking like a fund of funds, for example, a fund of funds might have 20 different funds. Generally, people are paying attention to the bottom 3 every year. If you don't want to get fired, don't be in the bottom 3. Usually. You can't obviously manage your business around that, but there are certain strategies that make it less likely you're going to be the bottom 3 in every year. The place I worked had a strategy that I think was more likely to produce that. And so as I thought about building my business, I certainly am comfortable with volatility. I think in investment management business, you have to want to generate good above market returns, and that should be the goal. But there are ways you can do that that are likely to produce tails on both the high end and the low end. And ways to do that where you avoid those tails. And I think generally avoiding those tails tends to lead to a more viable business over time. And again, some people like that. And so if you're meeting with someone who's like, I don't care about vol, I just care about like highest possible CAGR. If that's you, great. If it's not you, just be honest. And they might not invest, but I'll tell you, there's a whole list of other people that might say that, but don't actually believe it, or like believe it in theory, but in practice, they don't want to sit in an investment meeting where they have to explain why a manager they invested in is down 50% this year. It's not fun. So again, know yourself, know your investors. But I think another thing people can do is just think about there are certain strategies that are more or less likely to give you a good business over time. I'm generally a fan of strategies that are likely to leave you in business for a long time, for strategies that run the risk of huge flare ups and flare downs and leave you unemployed and miserable and feeling like a failure, which I'd love to go through the rest of my career never being somewhere where I felt like we've just done terribly for LPs over any period of time that's more than a year or two. I think that's really hard
So beyond marketing, you obviously have to put together a portfolio, which we've discussed, but you do have to put together a team and pick service providers. So beyond your prime, what else do you need to focus on for day one?
So prime is one. If you launch in with enough money, you can potentially do dual prime. If you're not launching with a lot of money, or if you're launching long only, typically need to do single prime. The fundament is pretty important. So again, I'm not endorsing any different providers, but if you talk to primes, you talk to some of the primes that work with smaller launches, they'll recommend a lot of good ones. I think fund admin can be really expensive. I didn't appreciate how expensive it can be. In our case, we kind of went middle of the road. But I think there's kind of at one end of the spectrum, you have something like Morgan Stanley Fund Services, which is very expensive. That's for, I think, like really premier launches. At the other end of the spectrum, I've heard of NAV, which I know a lot of small funds that use. I think for people really highly of, but that can be a really expensive cost. I think at one end of the spectrum, I think more expensive ones can be like minimums of 50 to 100K. And especially if you're launching with like 10 to 15 bucks, is a lot. And my impression is NAV is a lot kind of cheaper. Another thing that's important is legal. There are lots of different ways to spend money on legal. You can hire some white shoe law firms who will gladly help you start a fund for $100 to $200,000, or you can choose some more boilerplate stuff that's probably like 10 to 20 grand. I think it depends on one situation. One of the benefits of working with a larger firm is they have a lot of good information about the fund business. For those of you that haven't seen it, I think Stewart and Kissel puts out a fund manager report that has some really interesting data on fund launches and fees. But I think if you have that and marry it with a cheaper firm, like it's probably okay in most cases, especially if you're not doing side letters. But legal is pretty important. That has a longer lead time in general. I think if there's different structures you can have, I know Max we talked about like C7. I don't have any experience with that. But one thing, depending on where people work, they might be familiar with kind of offshore, onshore vehicles. One thing I didn't realize, but wish someone had told me, is if you launch with the onshore and offshore fund, both of them, your cost basically double for everything, which I wish someone told me. No one did. Alas, so like that's just a very easy point of distinction there. Most people, again, depending on the firm, but typically people have some type of outsourced COO if they don't have them in house for a launch above a certain size. That's a really important one. I decided to hire a COO pretty early on because I didn't want to have to think about anything other than marketing. It's obviously expensive. If I had less money, I probably would have looked for an outsourced COO and done that on the earlier side because there's all kinds of stuff and documents you have to fill out when you're going through all these different agreements, and having someone that can handle that is, I think, really nice. There are kind of fractional COOs that you can get referrals from with primes that can be helpful in that regard. Tax audit, I think, is it's one of the most expensive things. It's also one of the things with one of the shortest lead times, but there's like no way around it's going to be expensive. There are different firms, different tiers. Even the cheap ones, I think, are expensive, but is what it is. When you get a little bit bigger, you have to get cybersecurity. That can be pretty expensive. But look, I mean, in the grand scheme of things, it depends kind of the size of the business you want to have. All of these costs, so they're fund costs and management company costs. Some of these are fund, some of these are management company. The problem is for both of them, even if it's a fund cost, if you're gonna have a $10 million fund, you don't want to have $200,000 of fund expenses because then suddenly your returns are going to be 2% less. So this is, again, these are one of the reasons to talk to primes early on. They can give you like sample budgets of all this stuff. You can delay some of these decisions until what size firm you have. Service providers, everyone's different in terms of what they care about. Like the reality is you can talk to the prime. They know like which service providers, like people trust, people don't. You get no brownie points for choosing a unique service provider. I think like the fund admin's like pretty important. I'd say that's the big one. The prime's pretty important. Audit, I think, is less important, in my opinion. I mean, you need someone that does a good job, but I think like Big Four is probably overrated, but the cost delta isn't as much as I would have thought. Legal counsel, I don't think people care about a whole lot. You can kind of upgrade that over time too as you need, but this is an important decision because it's going to influence your costs. I think the big one is just like what team structure do you want? So like to the degree you work at a firm that has a lot of expert networks, like if you were doing expert network calls, 100 calls a year, congratulations. Once you have to pay for that, depending on if you transcribe or not, that can be 400 or 500 at the low end to $1,200 at the high end. If you want sell side research, congratulations, like they get paid. If you have relationships for a fire firm, like in theory, you can take all the sales reps that you worked with somewhere and call them up and tell them you're starting a business and hope they turn you on for research coverage and forget about you. If you do that, that's a pretty good way to continue to get research without having to pay people much. If you want to talk to analysts, there's the way to do it where you pay them some amount of money Or if you're enterprising, you can, if you have a CapIQ login, you can go and see all the analysts that cover a name. You can call them up and say, I have 5 minutes of questions for you. Like, I'm XYZ from YZ place, and sound like they know you and your buddies and they should know who you are. You say you're going to talk to them for 5 minutes, do a calculus in their head of, do I really want to like log this in the system? It's only going to be 5 minutes. Or should I just take the call? If they're the analyst to cover a name, you do that 8 times. You'll probably have 2 people that will talk to you. These are all the tricks of the trade of having been scrappy. And one of the benefits of being at smaller firms, you just learn how to do this. Like, you play poor, you need kind of CapIQ or Bloomberg or whatever cheap alternative exists. Like, you need all these things. You need to figure out how to pay for all of them. And so I think another thing that's helpful is just like how much you're comfortable burning. And so I think this is where it's helpful, right? Like, I think I heard advice which I generally believed, which is like you should have 3 years of living expenses and figure out how much you want to spend, how much you're willing to risk building your business, and assume you get friends and family and personal capital, and that's it. And figure out if you want to count the compounding of your own capital and your budget, and you should plan for that. And if that scenario scares the hell out of you, I don't think you should launch an investment firm. If you can look at that and it'd be painful, you could survive it, then it's going to be a lot easier because you have mentally budgeted in your head that this could go this way, and the scenario, I can live with that. I think it works a lot better than like not planning that at all. And you go and you're like, oh crap, I'm going to run out of money in a year and a half if I don't get investors. And it's very obvious if that's you and you wear it on your sleeve, and you will not raise money if people smell that desperation. So again, this is one of those things you do very early on. You figure out kind of the size of your business, where you're comfortable burning. Other expenses like rent, that's pretty easy to get around at this point. You can get a conference room space somewhere and work out of your apartment. That's not a big deal. Like, people won't know. You can eventually get office space later if you want. If you want to hire a team or not, or I want to hire a COO or not, these are all kind of decisions made. In my personal experience, like, I kind of had a view of what the worst case scenario is. I was willing to burn through like 25% of my net worth trying to build my business, and I budgeted for that. And I'm glad I didn't have to do that, but I was willing to do that, and that made things easier. But if I tried to start my investment firm 10 years ago, like with a family, a young kids, like, there's no way hell I would have done that. And so these are all the things you need to answer for yourself before you decide if you're ready to do it. Because that is one of the reasons why being younger is helpful, because the consequences of you being 27 and having to like have roommates is not as bad as, being 40 and having 2 kids and having to move somewhere because you can't afford to pay your bills or other things. So these are all kind of personal decisions. But I think those are some of the high level things I'd say.
All right. Well, we'll leave it right there. Thank you so much for doing this. And just a reminder to everybody, this is being done out of the goodness of your heart to share information. There's really no reason to do it otherwise. So thank you very much.
Thank you.
Looking into the AI Academy from Fundamental Edge? Check out the link in the description to review the curriculum and reserve your spot today. Thanks for watching.